Hi, my name is Jordan Wilson. In this episode, we continue our look at dollar cost averaging. And today our focus will be on how it creates the ability to maintain more discipline in your investing approach. Now, this is quite similar to what we looked at in the previous episode, which was consistency. But there's slight variations between the two, so I decided to separate them out. So with a disciplined approach, now in a perfect world, as an investor, you're going to create a detailed investment plan. That's where you look at your investor profile, figure out your financial objectives, the constraints you have, your financial situation, and realistic expectations for the future, your risk tolerance, those sort of things. They go into who you are as an investor and will drive the target asset allocation that you should pursue. And then once the asset allocation is in place, you begin to construct your portfolio. And presumably that will be either through lump sum investing or dollar cost averaging. Now, the reality is that the overwhelming majority of investors do not build structured portfolios. That is, they do not create investor profiles that drive target asset allocations. And then they build the portfolio in a structured, systematic approach. And what happens instead is that most investors just create piecemeal portfolios. There's really not a lot of thought to how each piece fits together. It's just, oh, I've heard that Apple is a good stock to buy. I'm going to add that. Jim Cramer on CNBC likes Netflix. Better add that. And suddenly you wake up one day with a portfolio. And there's also the issue of what I like to think of as January in Western Canada. You're building up your portfolio, or at least accumulating wealth so that you can buy a stock or a bond. But then it's minus 40, January 15th, and you've got some money sitting in your TFSA or just in your regular bank account, and you decide, there's a seat sale to Puerto Vallarta. That seems like the place that I should go spend some time. And that turns out to be your quote-unquote investment. So again, there's other factors that come into play. And the big one tends to be the emotional side of investing. When should I buy? When should I sell? On the one extreme, there's the fear of missing out. We're in a bull market. Everything's rising. I'd better jump in. Well, when you jumped in, someone else is selling, so they think maybe that we've hit a peak. Are you jumping in at the right time? If the markets are up 20%, how much more room is there to grow? And that's kind of where we are today in a lot of the equity markets, is that they have gone on a very lengthy run. Will the COVID-related stimulus packages continue to drive future growth in the equity markets? Or is there the fear of inflation coming because they're printing so much money? So these are kind of issues. When do I buy? Do I get caught up in an investment bubble? And you can go back all the way to the tulip craze in the Netherlands many, many decades ago. As an example, more recently, in the late 90s, early 2000s, we had the dot-com bubble. So again, am I buying into the market when it's overinflated and then suddenly someone pops it like a pin into a balloon and I'm on the losing end for an extended period of time? So there's sort of that fear. Everyone else is buying, I'd better buy. On the other side, there's also that fear to invest for some people. Again, right now, markets may be overheated. Maybe there's a higher probability that there will be a correction in the short term anyways. So maybe if I've got $12,000 that I was going to invest in the next month, maybe I want to wait a while. Or maybe I want to now start using dollar cost averaging and spread those purchases out over a period of time. But again, that emotions or lack of structure in your portfolio and its plan for investing, that's what's driving you. It's not, here's what we will do, and we execute. And I don't think that emotional investing or piecemeal approaches tend to be the best way to accumulate wealth over time. I think a dollar cost average approach does help maintain or create discipline in your investing patterns. Upfront, before you even begin to invest, you should create an investment plan. That's going to be, again, your investor profile, your target asset allocation, but also the portfolio construction. How do I build that portfolio over time? And that's your investing pattern. We saw a couple of episodes ago when we looked at market volatility that in the long run, an initial lump sum approach is superior. But we also saw that in the shorter to medium time frames, and we're talking 20, 25 years, that there's a lot of volatility on both sides. So markets can outperform and then they can significantly underperform. And depending on when you jump in, you may suffer for a 10 or 15 year period before you get back to where you were when you initially bought. So again, dollar cost averaging will smooth out that market volatility over time. Investors are still human. And you can be as disciplined as you think, but even the professionals get swayed by emotional factors. By having a solid investment plan that meets your objectives, that will help keep you disciplined on the straight and narrow as you go through this volatility and external factors that come into play. And I talk here a bit about having a soberly developed construction plan. And by that I mean we want to come up with our investment pattern, our approach, when there isn't that uncertainty or volatility in the markets. I want to sit down when everything is calm, my life is in order, and say, this is the way I want to invest. Instead of, oh, the markets are potentially about to crash, I'd better now develop an investment plan. And then you start bringing in these external factors that shouldn't be playing a part in your long-term approach. Another thing I think that dollar cost averaging is good for is that you start to see some benefit over time. And if you see that progress in your own portfolio, then you know it actually works relatively well. And then when there is the market volatility that comes in the future, you say, oh, we've gone through this already, and this is the right approach to take. And that again helps maintain that discipline and consistency that we talked about in the prior session. The final point I wanted to make today is just a very brief one, is that everything is sort of driven in dollar cost averaging by quality. You want to invest in solid, long-term assets. And that's something we'll look at in the next episode, is just considerations that dollar cost averaging is better suited for well-diversified investment products, as opposed to perhaps buying individual stocks or bonds. It still works, but again, to be able to invest in the quality will help you a bit when the market is volatile, because individual assets themselves have the stock-specific, the non-systematic risk factors. Whereas if you're in a well-diversified portfolio, the market as a whole, for example, then you really only have to worry about the systematic risks. And that makes it a little easier to cope with market volatility, is when you're only worried about the market risk as opposed to the market risk plus the individual and unique risk factors of a stock, for example. So that's it. We've covered a little bit on market volatility. We've looked at consistency. We've looked now at discipline, and we'll finish up a bit with quality assets in the next episode. Thank you for the time. Have yourself a good day.